Hi, my name's Amandeep. I'm a senior analyst for the AHDB Cereals and Oilseeds Market Intelligence team. In today's market update, we'll be focusing on the USDA's first projections for 2017-18. These were published on the 10th of May and suggest that the outlook for next season may be finely balanced. From a total grains perspective, 2017-18 is forecast to be the first deficit year since 2012-13. And as you can see in the graph, with overall consumption forecast around 24 million tonnes higher than total production. Looking at the major global grains, total maize production is projected to be around 21 million tonnes lower than demand. So there's a deficit there, and it's a bit larger than the maize deficit we saw in 2015-16. At 195 million tonnes, global closing stocks for maize are forecast 13% lower year on year and the lowest since 2013-14. For comparative purposes though, it's more meaningful to look at the stocks to use ratio rather than just closing stock levels. And the graph here shows that the maize stocks to use ratio is forecast to fall to 18.5%, which was the same in 2013-14. Moving on to wheat then, production is expected to be higher than demand, but the expected surplus is much lower than we've seen in recent years, at around 2.8 million tonnes compared with an average of around 24 million tonnes in the past 4 years. So there's a risk there that the projected surplus could be eroded very quickly due to a weather event, for example. Basically, there isn't much leeway. Global wheat output is expected to be lower year on year in 2017-18, but if realised, would still be the second highest on record. Demand is expected to be slightly lower, so overall global closing stocks in 2017-18 are expected to be higher. The stocks to use ratio is also expected to climb to 35.1%, which is a record, but this can be a bit misleading. What we need to do is consider Chinese wheat stocks. First of all, there's a healthy amount of skepticism about the reliability of this stocks data, and secondly, if the stocks are physically there, it's unlikely that they will be available for the rest of the market if there was a non-Chinese supply issue. So we can't really rely on Chinese stocks to provide a cushion for the market. The next graph here shows what the stocks to use ratio looks like without Chinese stocks. So if we subtract China from the global stocks to use ratio outlook, then the message is very different from what the headlines are saying. The global wheat stocks to use ratio excluding China in 2017-18 is forecast at 21%, and that's the lowest since 2007 and 8. So if there was a global supply issue in the near term, there might not be as much mobile stock around as the headline figures suggest. Finally, if we turn to oilseeds, global soybean production is expected to decline in 2017-18, but still forecast at the second highest on record after the 2016-17 crop. Global demand is expected to increase by around 4% to a record 344 million tonnes, but a slight surplus is expected. Closing stocks, as well as the stocks to use ratio, are projected lower in 2017-18, but are still one of the highest in recent years. The take-home message from these projections, and the thing to bear in mind, is that even though 2017-18 output is generally forecast lower than consumption, record level stocks from 16-17 are expected to provide a cushion. However, with stock levels generally expected to deplete next season, the market is much more open to supply shocks going into 2018-19, which could increase volatility. We'll soon be publishing a prospects article which stress tests the 2017-18 USDA projections and examines different scenarios, so keep an eye out for that as well as other news and analysis on the markets website.